Welcome back, everyone. Today, we're diving into the intriguing world of the buying the dip strategy, a method that many investors and traders come across at some point. At first glance, it seems simple. Buy when prices drop, wait for recovery, and make a profit. However, the reality is often more complex, as various factors can impact your decisions and outcomes. Before you even think about making a purchase during a dip, assessing the overall market trend is crucial. A stock may exude the appearance of a bargain, but if the broader market is on a downward slope, that stock could plummet even further. So what are the indicators that can guide you? The moving average, particularly the 200-day moving average, comes into play here. When prices hover above this average, it hints at a long-term uptrend. Conversely, prices below suggest a downtrend, waving a cautionary flag for potential purchases. To refine your analysis further, consider the Relative Strength Index, RSI, a crucial tool in your trading arsenal. This metric measures whether a particular stock or the overall market is overbought or oversold. An RSI reading below 30 signals that a stock is potentially oversold, indicating a buying opportunity on the horizon. However, tread carefully if the RSI exceeds 70, as this may indicate overbought conditions and suggest a possible impending pullback. When engaging in the buying the dip approach, it's vital to maintain a balanced mindset. Emotionally reacting to market fluctuations can turn a sound strategy into a precarious gamble. Always have a plan and a clear exit strategy to manage your risks effectively. Setting stop-loss orders can also serve as a safety net, providing a layer of defense during unpredictable market movements. In summary, the buying the dip strategy can be a valuable addition to your investing toolkit, but it requires careful consideration of market trends and indicators. By arming yourself with knowledge and employing tools like the moving average and RSI, you can make more informed decisions, reducing the chances of catching a falling knife. Remember, patience and diligence are your best allies in the fluctuating world of trading. Let's keep learning and growing together. Fundamental analysis serves as the compass guiding investors through the turbulent seas of stock prices. Before diving into a purchase, grasping the health of a company or asset is crucial. A seemingly low stock price might sparkle like a gem, but the context of that decrease is paramount. Often, those glimmering prices can mask underlying issues that are less obvious at first glance. The first signpost on this journey is revenue growth. A company that consistently grows its revenue year over year demonstrates resilience and adaptability. Picture a robust tree in a storm. Strong roots allow it to withstand harsh weather. Similarly, companies showing revenue growth are typically more equipped to rebound from downturns. They possess a solid foundation that may promise favorable returns in the future, providing comfort amidst market volatility. Next, we must examine profit margins. Profitability is the sun illuminating the path forward. Companies generating profit can comfortably navigate challenges without compromising their integrity. Visualize a ship equipped with ample supplies, sailing confidently through murky waters. Conversely, a company struggling with losses is akin to a vessel with leaks, susceptible to sinking in turbulent times. High profit margins provide a safety net that cushions against adversity, enhancing long-term stability. An equally significant factor in this analysis is debt levels. A company with heavy debt resembles a tightrope walker burdened with weights. Any misstep could trigger a downfall. During economic uncertainty, excessive debt can suffocate even the most promising ventures, making it crucial to assess a company's balance sheet. Like a fortress, a company fortified by manageable debt is more likely to endure the chaotic atmosphere of fluctuating market conditions. As we draw conclusions, understanding the root of a stock's decline offers invaluable insight. If a drop stems from short-term distractions such as an earnings miss or a delayed product launch, there might still be room for optimism. However, structural issues like declining market share or management malfunctions signal deeper problems requiring caution. This keen observation becomes the armor protecting investors from potential losses, empowering informed decisions. In the end, fundamental analysis equips investors with the wisdom needed to navigate financial landscapes. By scrutinizing revenue growth, profit margins, and debt levels, one can forge a path towards safer investments. As with any journey, knowledge and understanding lay the groundwork for success, enabling investors to discern the diamonds from the rough. Technical analysis is an art of interpreting charts to forecast a stock's trajectory. Among its core elements, support levels stand out as significant indicators of potential price reversals. These are the price points where a stock has previously found stability, bouncing back repeatedly. Visualize a trampoline. When it dips to a certain level, it bounces back up. This dynamic creates a safety net for traders as they analyze risk and reward based on historical data. To identify support levels, traders delve into past price movements. Imagine tracking a stock's performance over time and noting where it consistently rebounds. If a stock repeatedly bounces off the $50 mark, it indicates a swift recovery at that level. Traders can illustrate these points on charts with horizontal lines that serve as markers. However, it's crucial to remember that support levels are not immutable. Fluctuations in market conditions and trader sentiment can shift these critical points over time, requiring continuous monitoring. Resistance levels represent the flip side of the coin. These are levels where a stock struggles to surpass, acting as a ceiling. Visualize a bird trying to fly higher, but faced with an invisible barrier that keeps pulling it back. As the stock approaches a resistance level, it often encounters selling pressure from traders looking to secure profits, resulting in a pullback. Observing where these levels lie on a chart can help traders anticipate potential downward movements as prices fluctuate. Balancing the analysis of support and resistance equips traders with the insights necessary for making informed and strategic decisions. Navigating the trading world necessitates a keen understanding of both support and resistance. Each serves as a guide, revealing possible entry and exit points. A trader eyeing a stock nearing a support level might consider this an opportune moment to buy, betting on a bounce back. Conversely, when observing a stock near a resistance point, caution prevails as selling pressure looms. Over time, traders can develop valuable strategies, supported by continual analysis and observation, rendering their approach to market fluctuations more disciplined. In the end, mastering the technical analysis of support and resistance is pivotal in the world of trading. It allows traders to develop forecasts that are not merely speculative, but grounded in historical behavior. By combining these insights with diligent market monitoring, traders can stay ahead of the curve, making decisions that reflect an understanding of price movements and market psychology. Embracing this blend of analysis transforms how one navigates the ever-evolving landscape of stock trading. In the complex world of trading, understanding volume is essential. It's not merely about price shifts. Volume provides insight into the enthusiasm and validation behind those price movements. When analyzing trading charts, the volume represents the number of shares traded within a specific time frame, a crucial metric for any seasoned trader trying to gauge market strength or weakness. Take, for example, the dynamics at play during a price dip. When a dip occurs with low trading volume, it often reveals a lack of conviction among traders. A sense of uncertainty looms, suggesting that prices may soon reverse. During such times, it's critical to be on the lookout for signs of renewed buying interest at established support levels, which can indicate a potential turnaround. This combination of observing volume along with price movements can sharpen your trading strategy. On the other hand, when a dip is met with high trading volume, panic selling could be in play. High volume during downturns may indeed signal oversold conditions, presenting an opportunity for shrewd investors. Nevertheless, caution is advised. It's essential to interpret the underlying reasons for the volume spike. Analyzing the broader market sentiment can illuminate whether you're seeing genuine opportunities or merely trading on fear and distress. Beyond volume, several additional indicators bolster the toolset for technical analysis. Moving averages, for instance, smooth out price fluctuations over designated periods, with the 50-day and 200-day moving averages commonly employed to identify long-term trends. A price above these averages generally suggests an upward trend, while being below may hint at downturns. The Relative Strength Index, RSI, also serves as a valuable oscillator, helping traders discern overbought and oversold conditions. An RSI reading below 30 could signify a stock is oversold, while a reading above 70 may indicate it is overbought, suggesting potential sell signals as conditions balance out. Lastly, the MACD, Moving Average Convergence Divergence, is instrumental in identifying buy or sell signals by comparing two moving averages. When this MACD line crosses above the signal line, a bullish trigger ignites. Conversely, it's bearish when the MACD dips beneath the signal line. In conclusion, weaving together support levels, volume trends, and various technical indicators can refine your stock trading strategies. Embracing this multifaceted approach allows you to navigate market fluctuations with greater confidence. Ultimately, the fusion of technical analysis with fundamental data can pave the way for smarter trading decisions. At AlphaBridge Advisors, we empower investors with actionable insights and cutting-edge resources. Our mission is to bridge the knowledge gap, providing expert guidance on market analysis, investment strategies, and risk management. With unbiased research and tailored support, you'll make informed decisions and optimize your portfolio. Join our community today to access exclusive reports and strategic insights that keep you ahead in the dynamic investment landscape. Risk management is the cornerstone of successful trading. It's essential to recognize that every trader faces the potential for loss, and implementing robust strategies is vital. In this dynamic world of trading, the notion of risk can be daunting, yet it can also be the key to profitable investment. Just envision you're standing on the edge of a massive cliff. Careful decisions will prevent you from tumbling into the abyss. To navigate this landscape, a well-structured approach to risk management is indispensable. A significant tool in the realm of risk management is the stop-loss order. Imagine placing a safety net beneath your investment. That's essentially what a stop-loss does. By automatically selling your position at a predetermined price, it acts as a safeguard against abrupt market downturns. Picture your investment as a wild stallion. A stop-loss reins it in when it threatens to stray off course. This not only curbs your potential losses, but also helps maintain emotional balance during volatility. Critical in the heat of trading, position sizing is another vital element that complements effective risk management. Instead of diving headfirst into a potentially treacherous situation by investing all your capital, envision a more cautious approach. Scaling in, by allocating smaller portions incrementally, you reduce exposure while still taking advantage of market movements. This strategic layering allows you to navigate the ebb and flow of prices without drowning in risk, akin to finding your footing on slippery ground, one careful step at a time. Sentiment analysis adds another layer to the risk management strategy. It's about reading the market's mood, like gauging the atmosphere in a crowded room. If social media buzzes with panic or financial headlines scream fear, it may indicate a decline driven by emotions rather than fundamentals. This creates a potential goldmine for discerning traders, a chance to buy low when the market is oversold and the masses are fleeing. After all, as the legendary investor noted, seizing opportunity in the face of fear can yield remarkable returns. Incorporating a fear and greed index enhances your insight. When the scales tip into fear, prices often drop, creating buying opportunities for the astute trader. When sentiments are high and the market abuzz with excitement, consider stepping back. Risk management is not just a tactic, it's a mindset. With a vigilant approach to stop losses, position sizing, sentiment analysis, and the broader market context, traders can not only protect their investments, but also set the stage for strategic opportunities. In the world of trading, proactive risk management paves the path towards sustainable success. In the dynamic world of investing, it's crucial to look beyond the surface when considering a market dip. While one might be inclined to zero in on a single stock or sector, the broader economic environment often provides the essential context that shapes these fluctuations. Understanding how interest rates, inflation, and geopolitical tensions interlace with market dynamics empowers investors to make informed decisions rather than reactive ones. Take, for instance, the impact of rising interest rates. Typically, tech stocks, known for their reliance on borrowed capital to fuel growth, tend to bear the brunt of these increases. As costs for borrowing rise, the potential for future profits diminishes, leading to declines in stock prices. Conversely, sectors such as utilities and consumer staples, which produce essential goods and services, may experience lesser impacts, often presenting themselves as safer havens during turbulent times. This observation signifies the necessity of analyzing each sector's vulnerability to macroeconomic changes before jumping into a buy during a dip. When contemplating whether to invest during a market downturn, it's prudent to ask critical questions. Is this dip reflective of a widespread economic issue, or is it confined to specific stocks or sectors? By dissecting the underlying causes, investors can differentiate between a temporary setback and a potential buying opportunity. This differentiation is paramount, as it leads back to risk management, ensuring that one's investment strategy remains resilient amid varying market conditions. Recapping the essential steps before buying the dip involves not only examining the immediate trends, but also employing thorough fundamental and technical analyses. Understanding market sentiment is equally important, as it conveys the collective emotions of investors. This emotional landscape can be volatile and often drives decisions that deviate from logical assessments. Awareness of broader economic factors helps anchor one's investment approach, shielding against impulsive reactions to short-term events. In conclusion, navigating the complexities of stock market dips requires a tapestry of strategic considerations. By stitching together insights from macroeconomic indicators, sector vulnerability, and investor sentiment, one can enhance the probability of successful investments. So the next time you find yourself contemplating a dip, remember the multifaceted nature of the market. For more knowledge on investment strategies, don't forget to engage with our content by liking, subscribing, and sharing your thoughts. Here's to savvy investing.